One master you have to serve is expenses. You're never going to get away from that. If you put financing on it, you're serving a master of paying off the debt. But other than that, your masters are generally a combination of growth and income. You're gonna skew toward one side or the other. And if you're a heavily growth-oriented investor, and you can use the tool of a 1031 exchange, our view has been that it's better to use the 1031 and put it back into something that you think is going to grow again.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Mark Hamilton has been a player in the national commercial real estate industry for more than 30 years. His main professional focus has been locating value-add properties in changing urban neighborhoods and then reworking them into higher quality buildings and higher incomes, improved tenant profiles, and higher resale values. As of today, they have about $5 billion in assets under management. So this is somebody that we should absolutely pay attention to. Mark, welcome to the show.
Hi, Sam. Thank you for having me. And thank you for the generous introduction. Nobody's ever called me a player before. So,
Well, I certainly appreciate you coming on the show today, Mark. There are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Okay. So I started by accident. We can come back to that if you want. My wife and I purchased a duplex in a very rundown duplex in San Francisco in 1985. And despite the agony of dealing with it, the property made her mother cry. It was so rough. We kind of got bit by the bug. And so for a solid 15 years or almost 15 years, I practiced really only in San Francisco. Purchased a few dozen small buildings that needed a lot of tender loving care and heavy lifting. Eventually lost the ability to find the kind of yields that I wanted in San Francisco. So moved across the Bay and moved to other parts of the Bay Area, Oakland, Alameda, Hayward. And then in 2001, I met Tony Zanze, who had a very institutional pedigree and career to that point in time. It was a good marriage. I was good at getting my hands into the dirt and getting my arms around deals. He had a lot of really valuable institutional experience that helped us kind of work both sides of the barbell. That was 2001. Our first deal was 16 units for $1,150,000. Last year, we acquired about $1,150,000 in properties. And so it's been a steady as you go experience. Go show up, do the work every day, be careful. You better love the work because you're going to do a lot of it. And if you're lucky, you'll discover you're proficient at it. Primarily through being committed about it and putting your own skin in the game, and then you'll draw good people. We've been really lucky to draw a really great group of investors and a terrific staff. And we're building for the long run through that staff. But when there's treasure and you spread it around, it tends to work.
That is awesome. 16 units in 2001, so that's 21 years ago. Now you are at $5 billion in assets under management. What are some things as you review the last 21 years? How has risk shifted in the marketplace, and how are you guys addressing that today?
I think it's shifted. I think the single biggest component that's changed risk has been interest rate movement. Interest rate movement over the last 40 years, I'll refer to it as the bond market, as a bull run in the bond market. Rates were at 20 when I started my career. Last year, and when I say rates, it could be anything from the Fed rate to the 10-year bond, what have you. But last year, under in the pandemic, the 10-year bond went below 2.
Right.
So when interest rates go from 2 to 20 and rates of return follow, it means there's a huge amount of capital out there, ever more each year, chasing assets, and so you build up a lot of value. So if that's a risk, you got to be aware that it could change. Interest rates could go back up. I think we're probably finally at that time where interest rates are going to start going back up. Long-term rates, 10 years out, 5 years out, I think they'll probably still come back down. But rates are a risk. And then if you've held assets during the bull run, and as rates of return have gone down, you have a lot of made capital. And so you have to be careful about honoring what you want from that capital and what you expect to get in terms of preservation and returns.
When you say made capital, can you define that for me?
Sure. If you have a property and you buy it in a market that expects a 10% return, that means to induce one or more investors to come in and part with their cash to take your asset. And they're expecting a 10% return, which, I mean, that's a return we haven't seen in ages, but it makes the illustration easy. And you have $1 million of net income after paying all your expenses, whether it's in a triple net lease property where you have none and the income is pure, or in an apartment property where you have expenses to pay. But at the end of the day, what goes into your checking account, assuming you haven't financed it, is a 10% return, right? So it's $1 million, 10%. If $1 million is 10%, it means the value of the asset is $10 million, right? Cap rates haven't been at 10 in more than 30 years.
Right.
However, they have recently been in the range of 5. In a normal world, that would be the lowest they would go, but they haven't. They went even lower than that. Again, which means there's lots of cash chasing assets. Good value is hard to find, so people are paying up. But again, if you have $1 million of pure income, NOI, what's available after paying all your expenses, and now it's a 5% return market, that asset's worth $20 million. The income's the same, right? The property's the same. Nothing has changed. The only thing that's happened is valuation. And the big drivers of valuation movement have been capital. Capital is for years, if not decades, has been feverishly trying to find returns. And as there's ever more capital chasing returns go down. But that means the value of the assets go up. So if you're holding a highly valued asset and you think you might transact at some point in time, our feeling has always been it's better to sell when it's white hot than when it's rocky. So we I think meticulously evaluate our portfolio every month. And when we think we've really completed a business plan on something and we're not likely to do a heck of a lot better, we'll generally sell that asset. And the last 5 years have been a good time to sell assets. But if you sit on them and hope to get the same amount of money out at a later date, if rates of return have gone up at that point, which they are right now, then your values have gone down.
Right. And so that's what you mean by made capital, is when you're sitting on that property that is now increased in value. Do I sell it? That's made capital. Do I dispose of this property? Do I hang on to it? The ultimate question, I guess, that everybody's probably.
Yeah, and it's not an error to sit on it if that's your strategy. If it's a family asset that you want to hold indefinitely, then that's your asset. That's your strategy, right? You honor the strategy. You have a piece of the rock, and it produces income.
Right.
But if you're also trying to serve, so you're going to serve a few masters, right? One master you have to serve is expenses. You're never going to get away from that. If you put financing on it, you're serving a master of paying off the debt. But other than that, your masters are generally a combination of growth and income. You're gonna skew toward one side or the other. And if you're a heavily growth oriented investor, and you can use the tool of a 1031 exchange, our view has been that it's better to use the 1031 and put it back into something that you think is going to grow again.
Right. Absolutely. Do you feel like there should be a focus in an investor or in an investment firm's portfolio where they say, hey, we're focusing on growth or we're focusing on income, or is there a way to have both?
Yes, and yes, and yes. So your investment portfolio should serve your interest. Ideally, it'll serve your short-term interests, but it should serve your intermediate and long-term interest, right? So you're gonna make choices. You're gonna meet with somebody. It might be your spouse. It might be your mother or father-in-law. It might be your neighbor, right? It might be you talk it over with a CPA or with a wealth advisor. But I think you need to have a basic strategy. You need to be committed to it, which doesn't mean to be cast in concrete, but at least that'll give you a measuring post. And then you measure accordingly. In the early going, our emphasis was all on growth. We were simply finding things that we thought were undervalued. To get something that's undervalued, there's going to be some problems that come with it. Otherwise, there'd be a flock of people chasing it.
Right.
And you have to be prepared to do the corrective effort. You have to be prepared to put in the blood, sweat, tears, and money. That was you weren't even a wee lad there then. That was in 1985. So, since then, as we've succeeded and grown equity, our investors tend to have shifted to more of an income approach. They still want an expectation of growth. If you don't have the expectation of growth, you might want to buy a triple net deal. You might want to buy a bond. But if you have some expectation of growth and tax efficiency along the way, our investors expect that, but they're a little more centered on income right now. And some of that's about age, and some of it's about having racked up big gains.
Yeah, and I think that's an investor sentiment that I have in my investor conversations has been kind of shifting. And even the last 8 to 12 months, I hear a lot of investors who are calling me saying, you know what, I'm moving into the income side of things. I want a stabilized asset that is now producing revenue versus I'm looking for the home run. And I think that's coupled, two things go into that. One is the fear of an impending recession. And also, with that impending recession, also is just the fear that maybe the equity multiples aren't going to be there like they have been in the last 6 to 8 years.
Well, that's certainly true in the stock market right now. The stock market is correcting. People are looking at it through various lenses, but you can be sure that one of them is price earnings ratios, and price earnings ratios have come down. And again, that means that the value against its net income is not what it was because people aren't bidding for it to the same extent. Right. So, I think there are good reasons to be looking at income at all times. And again, I would say probably, I would say fully 60% to 2/3 of our investors at this point in time are content to collect income. And I think at this point in time, it's in part because they know there's going to be growth, right? A lot of folks have been with us for more than 30 years.
Wow.
So they know there's going to be growth. And then they can get, and because of that, they can get persnickety about income.
I love it. Yeah, and I think that's an interesting point there where you say people aren't bidding for it. Have you guys seen any softening in the multifamily market on the acquisition side and maybe even on the disposition side?
Yes, really within the last 2 years during the pandemic, with interest rates going down, cap rates went down too. Cap rates are the rates of return that we look at. And again, it comes back to that ratio of net income to value.
Right.
Cap rates went down just horrifyingly. There was a steep drop. And that's great if you're holding, right? It makes it harder if you're buying.
Right.
And so we're always buying. What we buy a little bit can differ. Certainly where we buy differ. But I think we figured out that in the last 21 years of Hamilton Zanze, we've been out of contract on an acquisition for precisely 1 week. We are always in the markets. It means you got to be concerned about overpaying, right? I mean, we can overpay. There's no limit. There's no law against overpaying. You can pay as much as you want. But we have to be careful. Our investors are friends and family and credentialed real estate people. They can pick apart a pro forma. And then we have marks. We have marks that we have to hit in part because people expect us to. They've seen it, right? So, but we're in 30 metropolitan areas. We're in 17 states, and there'll be probably 2/3 to 3/4 of those markets that we can't even look in right now as buyers because they're so fully priced, right? But we turn over rocks. We started out in one market, then we were in 2, then we were in 3, and over the last 21 years, we've grown to 30 markets, and it's just we look for places we want to be where there's good story, and then we start turning over rocks. And so we'll take in 3,000 to 4,000 submissions a year. After shaking them down, we'll underwrite maybe 250. We'll write offers on maybe 50. And we'll be able to get into the ring and get into the finals on 15 to 25 and come out with 15 to 18 acquisitions, right? And it's just because we have to find the returns. But you do it with hard work, you do it with persistence, you do it by forming relationships with people. And right now, in some of those markets, people are talking about transaction velocity in the second half of 2022 being off by fully 50% from the second half of 2021. And so we are seeing cap rates move back up. Leverage has come down. We're typically a 65 to 70% borrower. Leverage right now is probably mainstream leverage is going to be more like 50 to 60%. We can make that make sense if we like the asset because we're investing more for long-term income at this point. Not every time, but many of our partnerships have racked up big gains. And if people just get a nice steady ride and a pretty picture to look at, you're going to please a lot of people that way. But values have come back, and it's market specific. Rents are still white hot in Manhattan and in Brooklyn, so I would expect rates of return there have gone back down. In some of the Rocky Mountain states, some of the Mid-Atlantic states, cap rates have gone up. A broker told me the other day that in Salt Lake, where we've seen just like brutally low cap rates in the low threes, that case by case in Salt Lake, which is a highly desired market and a growth market, the cap rates may have moved by anywhere from 100 to 125 basis points. And what that means, nobody's sitting there watching a monitor saying what are cap rates doing. They're behaving. Right. We're all behaving, right? And what are we doing? We're either buying or we're not. And so fewer people are buying. The people that are buying are being more selective. And I think generally speaking, you're going to see a correlation between A, B, and C property, that A properties have probably held their value the best and suffered the least cap rate decompression. B properties are hanging in there, doing okay, and have suffered a little more cap rate compression. And C properties have gotten hurt the worst and have suffered a lot of cap rate decompression.
And again, that goes back, I think the key point there is to what is your strategy? Is it growth or income? I mean, and so we don't really care. We are proud owners of a C-class property that is producing an incredible income. And it's like,
as long as it's doing its job and it's not wobbling and you structured your financing so that you're not going to get whipsawed by hostile movement in interest rates, then the asset's doing its job.
Right. That's exactly right. Yeah. And so we're not, again, it goes back to the very point in the beginning, which is, what do you want out of this investment? Is it growth? Is it income? What's your strategy? And then honor that strategy. So that's,
so I think, I think for me, and maybe it's just because I've gotten on in years, I'm 63, right? So you're talking to almost an official senior citizen. But at this point in time, I just want it to work out, right? I want stuff to work out. And that doesn't mean I want to move to the sidelines. I'm too fidgety to move to the sidelines. But you have a basic strategy, and if it works out, it's doing its job. And so we know that we can make it work with growth and income. We knew we could make it work with growth. There wasn't much income. It was mostly about it. It was a big renovation business. But we know how to do it with growth and income. We know how to do it with income and growth. We took down a portfolio in bankruptcy last year of almost 60 properties. And we knew it had been mismanaged, and we knew that it was out of the reach of most investors who would bid for it. Right. So we felt we were getting good pricing going in, and we felt we knew we could run the portfolio. We were uniquely positioned because it was both apartments, which was probably 2/3 of the value of the portfolio, and suburban office. And we have an affiliated company that does that. And the other thing too is on our home court. It's in the Bay Area. Right. So nobody's ever going to be nonchalant about a bona fide growth deal. But at the same time, you those sort of things are, I guess the term in the stock market is unicorns, right? Those things are unicorns a little bit. So if we didn't catch a unicorn, we at least caught a horse with a bump on its head. But everybody likes growth. And if it's real growth, you're not going to have any trouble having people be interested. But at the same time, you have to look at what's sustainable. And investors want what's sustainable.
Yeah, that's absolutely right. Absolutely right. Tell me this: is your view in the market right now? Are we in a lull? Is this the eye of the storm? Where are we right now? And where are you guys positioning yourself for the future?
That's a really good question. And curiously, I think events on the global stage are going to affect the U.S. real estate markets more than you might expect.
Mhm.
Certainly, inflation is a worldwide phenomena right now, and it's going to affect worldwide interest rates. On the other hand, the United States is also still a haven for investors, and there's certainly inflow of foreign capital. We don't deal with foreign capital very much. We deal with it a little bit, um, and so I think there's certainly the likelihood of stability. It won't be perfect stability. It's gonna, we'll suffer some cap rate decompression just like anybody. But what's happened on the world commodities market because of central banks flooding economies with money, and because of the war in Ukraine, in terms of the impact on energy, commodities, et cetera, is a big deal. Any instability in China would be a big deal, and they have people there that are publicly boycotting making interest payments on properties that they have never been delivered to them. And so, growth. I think it's fair to say that China has made rising economic prosperity and rising stability and rising growth rates a pillar of their whole form of government in terms of keeping people bought in. And so when you see growth start to slow down, which it has in China, and then when you see people boycotting mortgage payments, that's a concern. It should be a concern. It will affect the world market. And then domestically, it's interest rates. I don't think there are any newfound challenges in the tax code that are going to drop on us. I think Fannie and Freddie are going to be there for the duration in terms of being capital providers, being debt capital providers. And so it comes down to operations. And I won't say that we're protected from a downturn affecting working people in the United States. I don't think we're protected. I think that occupancy exposure and delinquency exposure is going to be the lowest with A plus properties, and it's going to be the highest with C minus properties. So you just have to be prepared to be that operator if you have a real occupancy and or delinquency challenge. And I think there will be some of that, but let's be honest. I mean, unemployment right now is at 3 to 3.5%, and there are a lot of people who are just saying, it's not good enough for me yet. I'll wait it out. I'll find a job, but I'm not in any hurry. And household formation is still on our side. We are probably 85% of our investment activity is in multifamily. We do have investment activity in our suburban office platform, but the vast majority of it's multifamily. And what we experienced in the Great Recession, so-called, was that if we met the market, did a good job operating the properties, kept the staff happy, and kept people in their apartments, it is a little bit of it was a refuge for us. It was a harbor for us in a rough time. Because if you can win your occupancy, you've won a big part of the battle with multifamily.
Absolutely. Absolutely. Mark, this has been fascinating. Thank you for taking the time to come on today and just kind of give us a breakdown really on the current events, how you see things through a lens of how many years is that? 15, 20, 30 years?
The dirty secret is 40, but I didn't buy my first property until 1985, so 37.
Okay.
The year I got married.
That's awesome. I absolutely love it. If you could give our listeners one piece of advice that pertains to investing today, and you said, hey, this is what I recommend to anybody who's investing in commercial real estate, what would it be?
Commit to, for your own sake, commit to staying power. What's your staying power strategy, right? If you're starting out, what's your income going to be? Do you have no need of an income? Do you have an income stream? Do you have a spouse that's bought in that provides enough income? But you got to commit to staying power, and that means your own, because you will want to eat and do the thing that I did this morning, which is get out of bed. You will want to be able to do that every day and meet the challenges. Right? Multifamily is a very activity-based business. Right? It's a very demanding daily business. So you have to be prepared to meet that where it is. And then you have to have a strategy that's an asset strategy that is going to allow you to navigate it when when things aren't so great and benefit from it when things aren't. So, I mean, I would say commit to staying power and satisfy yourself that you've answered those questions.
I love it. I love it. Mark, thank you so much for coming on today. If our listeners want to get in touch with you or your firm, what is the best way to do that?
Well, I'll tell you, we have a pretty good website that we like. Other people have told us that as well. It's Hamilton, Hamilton, Z as in zebra, N as in Nancy, Z as in zebra, E as in Edward.com. We think that tells the story pretty well. And then otherwise, my email address is Mark, M-A-R-K, at HamiltonZanze.com.
Wonderful. We'll make sure we put those things there in the show notes. Mark, thank you again for coming on today. Certainly
You
appreciate
bet,
it.
Sam. Thanks for having me. It was fun. Good luck with your property.
Thank you, sir.